All right, Shanay Shah joins us now, President with Shalby. Let's take our conversation forward, talk about quarterly numbers and how things could transpire for FY25. Shanay, good morning. Thank you for joining us. For FY25, we've seen good improvement in margins, a decent improvement in PAT, and the occupancy rate was up by nearly 10%. Could you broadly tell us for FY25, you think this kind of growth momentum will sustain, which is like a margin improvement, occupied bed improvement, as well as any revenue improvement?
Yeah, sure. Good morning, Nikunj. Thank you for having me. And in fact, this has been a landmark here for the hospital group. We've completed 30 years in operations. And at the standalone level, we have crossed 200 crores in EBITDA that we had projected for the year and about 100 crores of PAT. There has been a double-digit kind of growth that we have seen, in the revenues as well as the inpatient count, which has been close to 20% year on year and about 15% on the inpatient growth count. It is just because of the case mix that the average length of stay has been lower, and hence the occupancy growth is seen at about 10%. However, if you look at FY25, at the standalone level, we'll again expect a 20% level growth at the hospitals business, which will take us to about 1,000 crores from the current 850 crores. And for the acquisition that we made in Delhi is expected to do an additional 150 crores, and the implant business will do about 130, 140 odd crores. So we are looking to close FY25 at anywhere between 1150 to 1200 crores top line.
Can you tell us then the sense of your cash flow for FY25, because there is going to be money which would be used for acquisition and for new capacity generation. So what about cash flow? Would you be generating free cash flow this year?
Yes, absolutely. The only acquisition that we did was last year, and in fact, in this year we are operationalizing Rajkot, which is a franchisee unit where we are not investing in the land and building. And the significant cash flow, of course, will be coming in from the hospitals business, where we are looking to generate more than 20% on the EBITDA level. And a large part of that will translate into the free cash flow, everything other than what will go into the working capital in the implant business for this year, which will be to the tune of about $10 million.
What would be your mix, let's say, for FY25 and beyond in terms of company-owned hospitals which you are generating versus the so-called asset light and the franchise model?
So since the franchisee model is still in a phase where it's a fast-growing business for us, we have grown 40% from FY23 to FY24. However, it is a small piece in the total hospitals pie. So we still believe that the hospitals will continue to contribute over 90% of the top line, and the franchisee units will be doing less than 10% for FY25. Going forward, we expect the mix to change though.
If one looks at the entire hospital landscape in India, competition and expansion has intensified, which is, I'm just breaking it for our viewers. Let's say if you needed good medical care and if you were in Uttar Pradesh, you were either coming to Gurgaon or you were going to Lucknow. Now within Lucknow and Delhi, there are 5 hospital chains. Everybody is expanding to tier 2 and tier 3 cities. So the patient count actually, which was going to major cities and major metros, is actually getting very, very localized. That's a big change there. The second big change is that PE investors are now really maximizing. They are really going in terms of getting margins back up. There are 2 fundamental changes which are happening in the hospital space. How do you see that changing life for Shalby?
Well, Shalby, I would say, has been ahead of the curve when it comes to, expanding in the tier 2 and tier 3 cities. So if you look at most of our hospitals, they are in non-metro cities. The most recent one being in Delhi NCR, but however, most of the others are in, the tier 2 and tier 3 cities. And we believe that genuinely there is a major demand supply gap in these cities. And earlier the concern was, not being able to attract the right talent pool in terms of doctors and paramedical staff. But things have changed and evolved over the last 30 years is what we have seen. And most of our units are doing really well. So, in fact, at the standalone level, all our hospitals have been EBITDA positive, and the average EBITDA that we've been able to generate across all these hospitals has been in the range of 20 to 25%.
Great to have you on the show. We'll leave you, let you go on that note. Thanks as always for taking the time out. Look out for the markets because, we're seeing a further cool off. We're down about almost 500 points for the Nifty Bank. For the Nifty as well, we're headed in for that 1% decline. We'll take a very quick break, continue tracking markets, and of course, speak with Dream Folks Management as well on the other side.